After the stock market closed on Friday, credit rating agency Moody's got in a mood, downgrading America's creditworthiness from a perfect AAA grade to the next best AA1 on account of running up massive deficits and paying an eye-watering amount of interest to service its debt. There are three major credit agencies, and Moody's was the last to knock the U.S. from the most pristine credit rating. The others, S&P and Fitch, downgraded U.S. credit in 2011 and 2023, respectively. Moody's hadn't lowered the U.S. stellar score since it issued it in 1919. But it sent it to rung number 2 on the 21-unit rating scale because the U.S. is letting its debt get out of control. Successive U.S. administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits and growing interest costs over the past decade, Moody's said. Here's what they're talking about. The U.S. government paid over $1.1 trillion in interest on its debt last year, Bloomberg Opinion noted. That's more than the Pentagon's entire budget. Moody's is concerned that the U.S. won't generate enough tax revenue to cover interest on its debt, meaning it would have to borrow money just to pay interest on the money it already borrowed. Treasury Secretary Scott Bessent dismissed the importance of the downgrade yesterday, calling Moody's a lagging indicator. Markets may also react with a shrug as trading opens this morning. After all, foreign investors have piled into U.S. debt since Fitch first downgraded the U.S. in 2011. Since that year, they've roughly doubled their holdings of treasuries and added $1.5 trillion since 2023, per the Treasury Department. Zoom out. Moody's downgrade comes as Republican lawmakers try to push forward what President Trump calls a big, beautiful bill, a large tax and spending package that is estimated to increase deficits by about $4.2 trillion over the next decade by extending and adding to Trump's tax cuts from 2017.